The greatest fortunes are not built by those who trade the most, but by those who have mastered the profound art of doing nothing. This sounds like a paradox, a contradiction to everything you've been told about the fast-paced world of speculation. You've been led to believe that success is a function of action, of constant vigilance, of being in the market every single day. But what if the greatest secret, the key to multiplying your profits not by 2 but by 10, was to learn the discipline of stillness? What if the real game was won not by jumping in and out, but by finding your position and sitting tight? This was the core philosophy of a man who treated speculation not as a gamble, but as a science, Jesse Livermore. And today we will dissect why his principle of sitting tight is exponentially more profitable than the siren song of active trading. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The average speculator is his own worst enemy. The human side of every person is the greatest impediment for the investor or speculator. This isn't an opinion. It's a diagnosis born from observing markets for decades and from the confessions of countless traders who have met their financial demise. The siren call of the market is constant. The ticker tape is always moving. Prices are always fluctuating. And the temptation to have an interest in every move is almost overwhelming. It's a human frailty, this desire for constant action, this craving for excitement. We want to be in every jackpot, play every hand. And it is this very human trait that, if left unchecked, will inevitably bring about a trader's downfall. It's the enemy that never sleeps. Livermore himself learned this lesson through immense financial pain. He recounted a time when he became strongly bullish on cotton. His analysis was flawless, his conviction absolute. He knew with a certainty that only deep study can provide that cotton was poised for a monumental rise. But the market itself was not yet ready. It was dull, lethargic, sleeping. Impatience, the eternal foe, whispered in his ear. He could not wait, he had to act. He plunged in with an initial purchase of 20,000 bales. The market flickered up on his buying and then, just as quickly, slumped back into its slumber. He grew tired, disgusted. He sold out, taking a loss. A few days later, the same conviction returned, the same undeniable logic that told him cotton was going higher. He plunged in again, buying back his 20,000 bales. And again, the market feigned a response only to fall back, lifeless. The process repeated itself. 5 times in 6 weeks he bought into a market that was not ready to move, and 5 times he sold out in disgust, each time taking a loss. In total, he chipped away nearly $200,000, a fortune at the time. He became so disgusted with himself, so furious with the market's refusal to align with his impeccable logic, that he ordered the cotton ticker removed from his office. He couldn't bear to look at it anymore. And what happened? 2 days after the ticker was removed, 2 days after he had finally surrendered to his frustration, the market started up. It didn't just inch higher, it exploded. It climbed 500 points in one of the most powerful and sustained rallies he had ever witnessed, with barely a single meaningful reaction along the way. He had missed it. He had lost not only the $200,000 in his futile attempts to force the market's hand, but also the $1 million profit that his original correct analysis had promised. The reason was simple and brutal. He lacked the patience to wait for the psychological moment, the pivotal point when the market itself confirmed his judgment. He let the craving for action replace sound strategy. This story is not unique to Jesse Livermore. It is the story of almost every trader who has ever blown up an account. They are often right about the market's direction, but they are wrong about the timing. And in speculation, timing is not just a part of the game, it is the whole game. The desire for constant action is a form of gambling. It's a bet on minor fluctuations, a desperate attempt to scalp a few points here and there. This approach, Livermore learned, is the road to ruin. The real money, the life-changing fortunes, are not made in the day-to-day wiggles of the tape. They are made in the great movements, the big swings. They are made by identifying the primary trend of the market and sticking with it. It was an old trader, a man nicknamed Turkey in the offices of Fullerton, who crystallized this idea for Livermore. While other customers would frantically chase tips and debate every minor dip and rally, old Mr. Partridge would listen politely, smile, and offer the same cryptic advice, regardless of the stock or the situation. When asked what he thought a trader should do, he would cock his head, offer a fatherly smile, and say with profound simplicity, "You know it's a bull market." At first this seemed like the ramblings of an old man, but Livermore began to study him and realized the deep wisdom in that simple phrase. Partridge was not giving a tip. He was stating a fundamental condition. He was reminding his fellow traders that the big money was not in trying to catch the individual fluctuations, but in sizing up the entire market and its primary trend. When a trader, Elmer Harwood, rushed in to tell Partridge he had just sold all his stock to take a quick profit, expecting a reaction, the old man simply shook his head. Harwood was insistent, reminding Partridge that he had given him the tip in the first place, and that the stock was up 7 points. "Now is the time to take your profit and get in again on the next dip," Elmer urged. But Partridge refused, explaining, "My dear boy, if I sold that stock now, I'd lose my position, and then where would I be?" This was the key. Losing his position. It wasn't about the stock. It was about his place in the major trend. He had paid a high price for his knowledge over many years, the tuition fee for learning that trying to jump in and out was fatal. He understood that in a bull market, your game is to buy and hold until you believe the bull market is nearing its end. This realization was a turning point in Livermore's education. He finally understood. It was never his thinking that made the big money for him. It was his sitting tight. Being right on the market is not the difficult part. You will always find early bulls in bull markets and early bears in bear markets. The true challenge, the quality that separates the successful from the forgotten, is the ability to be right and sit tight. It is one of the hardest things to learn, but it is the only way to make the truly big money. The millions, Livermore observed, come easier to a trader after he knows how to trade than the hundreds did in the days of his ignorance. The market does not beat most traders. They beat themselves. They have the brains, but they cannot sit tight. This principle of aligning with the major trend is not exclusive to Livermore's philosophy. It's a cornerstone of market analysis shared by other masters, most notably Richard Wyckoff. While their methods differed in presentation, the core idea was identical. To succeed, one must understand the market's true intention. Wyckoff developed a brilliant methodology for analyzing the market through its phases. Accumulation, when smart money is quietly buying. Markup, the sustained upward trend. Distribution, when that same smart money is selling to an enthusiastic public. And markdown, the subsequent decline. He taught traders to read the tape not for individual price changes, but for the story of supply and demand, to identify where the large composite operator was placing his bets. If Livermore taught us what to do, which is to sit tight and ride the big swing, Wyckoff provided a detailed, systematic framework for understanding when those swings were beginning and ending. He offered a way to diagnose the market's health and anticipate its next major move. The two philosophies are not rivals. They are perfect complements. They represent two sides of the same coin of market wisdom. For those who wish to delve deeper into this structural understanding of the market, the channel Richard Wyckoff Trading Methods is an invaluable resource. It breaks down these concepts, making the invisible hand of the market visible to the dedicated student. You will find a link in the description. By combining Livermore's discipline of patience with Wyckoff's analytical framework, a trader can build a truly formidable strategy, one grounded in the fundamental truths of how markets truly operate. The game is not to catch every fluctuation. The game is to position yourself in harmony with the great underlying force of the market and have the patience and courage to hold that position. This requires a profound shift in mindset, from that of a frantic gambler to that of a patient businessman. The market is not a slot machine spitting out random jackpots. It is a flowing river, and your job is not to splash wildly against the current, but to identify its direction and ride it to its destination. The real money is made by those who understand this, by those who have mastered the difficult art of sitting tight. To simply say buy low and sell high is the most useless advice in the world of speculation. The real question, the one that separates the consistently profitable from the consistently broke, is how. How do you confirm that what appears to be a bottom is not just a pause in a deeper decline? How do you know that a new high is the beginning of a major advance and not the final gasp of a dying bull? Jesse Livermore spent his life wrestling with these questions, and the system he developed was a masterclass in the mechanics of patience. It was not a system of blind faith, but one of rigorous confirmation, designed to ensure that when he did sit tight, he was doing so on a foundation of market-proven evidence. The cornerstone of his method was the concept of the pivotal point. This was not some mystical number, but a price level of critical importance. He observed that when a stock passed a significant round number for the first time, like 50, 100, 200, or 300, a fast, straight movement almost invariably followed. These levels acted as psychological barriers. Once breached, they released a new wave of market energy. He first tested this theory on the old Anaconda stock. The instant it sold at 100, he placed a massive order. The advance was immediate and powerful. He repeated the play when it crossed 200, and again at 300. These pivotal points were his signals to act, his entry gates into the big swing. He learned that waiting for the market to reach these points before starting to trade was the key to making money. He began his play at the psychological time, at the very beginning of a confirmed move. But a pivotal point was not just an entry signal, it was a validation point. The action of the stock after crossing the pivotal point was just as important. When Anaconda crossed 100 and 200, the advance was swift and sustained, confirming the strength of the trend. However, when it crossed 300, the follow-through was weak. It only moved a couple of points higher before stalling. The stock, instead of being difficult to buy, was being met with a flood of supply. This was a danger signal. The stock was not performing as it should. It was a clear message from the tape that the character of the market had changed. Livermore didn't argue. He sold his entire line and watched as the stock subsequently collapsed. This taught him a crucial lesson. A speculator must heed the danger signals. When a stock does not perform as it should after crossing a pivotal point, it is time to get out. The second pillar of his method was the principle of pyramiding, or buying on a rising scale. This is one of the most counterintuitive yet powerful concepts in trading, and it runs directly contrary to the amateur's instinct to average down. The average trader, buying a stock at 50, feels an irresistible urge to buy more if it drops to 47. He tells himself he's getting a bargain, lowering his average cost. Livermore saw this for what it was, compounding a mistake. If your first judgment was wrong, what logic is there in doubling down on that error? He preached the opposite. Never average losses. Let that thought be written indelibly upon your mind. His method was to start by buying a portion of his intended line, say 20%. If that initial purchase immediately showed him a profit, it was a sign that his judgment was correct, at least for the moment. The market itself was confirming his play. Only then would he buy the next portion, and crucially, each succeeding purchase had to be at a higher price than the previous one. If he bought his first lot at 50, he might buy the next at 51 and the next at 52. His trades at all times had to show him a profit. The fact that they did was his proof that he was right. If, however, his first purchase at 50 immediately dropped to 48, he was wrong. The market was telling him so. The correct action was not to buy more, but to sell what he had and take the small loss. This approach ensures that your largest commitment, your big bet, is only in place when you are demonstrably right on the market. This method serves a dual purpose. First, it is a powerful risk management tool. By cutting losses short on initial probes, you preserve your capital. The speculator has to be his own insurance broker, and the only way he can continue in business is to guard his capital account. But just as importantly, this method builds the psychological foundation necessary to sit tight. When you have a substantial profit on your line right from the start, you have a buffer. You have courage. You have the patience to sit through the normal, healthy reactions that are an inevitable part of any major trend. The man who buys at 50 and watches his stock go to 60 has a 10-point profit. If it then reacts to 57, he is not scared. He still has a 7-point profit. But the man who bought at 57 on the reaction, hoping for a bargain, has no buffer. A further dip to 55 puts him at a loss and fills him with fear, often causing him to sell out at the worst possible time, just before the advance resumes. The real money, Livermore stated from experience, was made in commitments that showed a profit right from the very start. Understanding the character of a stock's movement was the final piece of the mechanical puzzle. A stock in a definite trend, he observed, moves along certain predictable lines. At the beginning of a move, you see a large volume of sales with gradually advancing prices. Then what he termed a normal reaction will occur. On that reaction, the volume will be significantly less than on the preceding advance. This is healthy. It's the market catching its breath. Never be afraid of the normal movement, he warned, but be very fearful of abnormal movements. After a day or two, the advance resumes, and the stock pushes into new high territory. This pattern of advance and normal reaction repeats itself. But a time comes when the pattern changes. Perhaps after a long, sustained rise, the stock has a day of tremendous activity, a sharp run-up of 6 or 7 points, followed by a sudden, abnormal break of 8 or 10 points in the last hour of trading. The next day, it might try to rally, but fails to carry through to a new high. This, Livermore stressed, is an immediate danger signal. Something has changed in the character of the market. It is an abnormal reaction, something the stock has not done before during its entire advance. When something happens abnormally market-wise, it is flashing a danger signal which must not be ignored. You have had the patience to stay with the stock all during its natural, profitable progress. Now you must have the courage and the good sense to honor the danger signal and step aside. Convert those paper profits into real money. This combination of principles, waiting for pivotal points, pyramiding on a rising scale, and recognizing the difference between normal and abnormal reactions, formed the mechanical basis for Livermore's trading. It was a system designed not to catch every small turn, but to ensure that he was heavily committed to every great movement. It provided the structure that allowed him to practice the art of sitting tight. It wasn't a passive wait, it was a disciplined, watchful process of confirmation and validation. He had a definite basis for his anticipation. He waited for the market to confirm his judgment, and once it did, he backed it heavily and had the courage of his convictions to stay with it until the tape itself told him the party was over. This is not gambling. This is speculation treated as a science, a business where decisions are based on evidence, not on hope or fear. A man can have the most brilliant analytical mind and a trading system that is mechanically perfect, yet still fail as a speculator. The final battle is not fought on the trading floor or on the charts. It is fought within the confines of his own mind. The speculator's chief enemies are always boring from within. Jesse Livermore, despite his mastery of market mechanics, knew this all too well. He confessed that his greatest struggles were not with reading the tape, but with mastering himself. It is inseparable from human nature to hope and to fear. The tragedy for most traders is that they get these two emotions in the reverse position. When the market goes against you, you hope. You buy a stock at 30 and the next day it drops to 28. You are not fearful. You tell yourself it's just a temporary reaction, that it's certain to recover. You hope that the next day will bring a rally. But that, Livermore warned, is the very time you should be fearful. That 2-point loss could easily become a 4-point loss the next day and a 10-point loss by the end of the week. Hope, in a losing position, is the siren song of financial ruin. It keeps you from taking the first, small, manageable loss and chains you to a position that may eventually jeopardize your entire capital. The time to be worried is when your trade first shows a loss, not after it has grown into a disaster. Conversely, when the market goes your way, you become fearful. You buy that same stock at 30, and the next day it has a quick run up to 32. You are immediately gripped by the fear that if you don't take your small profit, you may see it fade away by the next day. So you sell, content with a quick gain. But that is precisely the time you should be filled with hope. Why should you worry about losing a 2-point profit you didn't have the day before? If you were right enough to make 2 points in a day, you might make 4 the next, and 10 the week after. As long as the stock is acting right and the market is right, you should not be in a hurry to take a profit. You know you are right, because if you were not, you would have no profit at all. Let it ride, and ride along with it. It may grow into a very large profit. Have the courage of your convictions and stay with it. This psychological reversal, fearing your profits and hoping for your losses, is the single greatest cause of failure in the speculative markets. Profits always take care of themselves, but losses never do. The speculator must insure himself against considerable losses by taking the first small one. In doing so, he keeps his account in good order, his mind clear, and his capital ready for the next real opportunity. This is a lesson that is easy to understand intellectually, but profoundly difficult to practice emotionally. The pull of hope on a losing trade is magnetic. The terror of watching a profit shrink on a normal reaction is palpable. How, then, does one combat these deep-seated destructive instincts? Livermore's solution was twofold: a commitment to meticulous record-keeping and an unwavering discipline to treat speculation as a business. He was, in his own words, a fanatic about keeping records. While others were mesmerized by charts which he found confusing, he maintained his own ledgers, his own price movement diaries. He insisted that you must keep your own records. You must put down your own figures. Don't let anyone else do it for you. He found that the very act of writing down the numbers, of engaging with the data himself, sparked new ideas and insights that no one else could give him. These discoveries were his own, his secrets. It was not until he began to merge the time element with his price records that they truly began to speak to him. He started to see patterns, repetitions, and formations that foretold the great movements. By keeping these records, he externalized his decision-making process. He was no longer trading on impulses, hopes, or fears. He was trading on the evidence he had painstakingly compiled. His records became his guide, his map for anticipating future movements. When a stock's action diverged from the pattern his records suggested, he knew something was wrong. If his stock did not act as he anticipated, he would immediately determine the time was not yet ripe and close out his commitment. His records provided an objective framework that allowed him to override his own flawed human emotions. This leads to the second part of the solution: treating speculation as a business. Anyone inclined to speculate, he urged, should look at it as a business and not as a pure gamble. If it is a business, then it requires work, study, and the application of sound principles. You would not expect to succeed in any other business by operating on whims and rumors, so why in speculation? He devoted 40 years to making speculation a successful business venture, and in that time he was constantly discovering new rules to apply. He would go to bed wondering why he hadn't foreseen a certain move, and awaken in the early morning with a new idea formulated, impatient for the day to begin so he could test it against his records. This business-like approach demands a level of detachment. The average person who speculates is too involved. They hound brokerage offices. They are glued to the ticker. They talk markets at all gatherings. They are so engrossed with the minor ups and downs that they completely miss the big movements. The speculator who insists on trying to profit from daily minor fluctuations will never be in a position to take advantage of the next important change. The real work is done in the interim periods, when you are doing nothing, letting the market shape itself for the next big play. In those quiet times, the impatient traders, the ones who feel they must trade day in and day out, are laying the foundation for your next venture. You will reap the benefits from their mistakes. Ultimately, the mastery of the human element is the final frontier for the speculator. The principles of waiting for pivotal points, of pyramiding correctly, of cutting losses and letting profits run, are all mechanical rules designed to build a fortress against the destructive power of emotion. They provide a structure for right action. But even with the best system, a trader can be swayed by the plausible charm of a tipster, as Livermore was with Percy Thomas in the cotton market, a mistake that cost him millions. He learned that another dangerous enemy is the susceptibility to the urgings of a magnetic personality when plausibly expressed by a brilliant mind. The final lesson is that a speculator must back his own judgment always. He must do his own seeing and his own thinking. The principles we've discussed are not abstract theories. They are the hard-won lessons from a life of immense wins and catastrophic losses. This life, with all its triumphs and tragedies, was immortalized in a book that has since become the Bible for traders around the world. Edwin Lefebvre, in his masterpiece, Reminiscences of a Stock Operator, did more than just recount the trades of the man he called Larry Livingston. He captured his mind, his struggles, and his evolution. He laid bare the psychological battles that every speculator must face. However, reading this book, written a century ago, and applying its lessons to today's complex markets can be a challenge. That is why the detailed, chapter-by-chapter analysis of this classic by Max Davidson is so invaluable. It is not merely a summary. It is a modern-day Rosetta Stone, translating the timeless wisdom of Livermore into a practical, actionable framework for the 21st century trader. It delves into the psychology behind each decision, the strategy behind each campaign, and makes the lessons learned by Livermore a century ago feel as immediate and relevant as today's closing bell. For anyone serious about mastering not just the market but themselves, this analysis is an indispensable guide. You will find the link in the description below.